school. Hey everyone, welcome back to the channel. Today, we're rediving deep into a topic that is crucial for anyone interested in trading or investing: the fascinating relationship between gold, silver, and the US dollar. Have you ever wondered why when you hear news about the dollar getting stronger, the prices of gold and silver seem to drop? Or why they often rally when the dollar is weak? It's not a coincidence, and understanding this stance is key to making smarter trading decisions. So, let's break it down. At its core, the relationship is what we call an inverse correlation. Think of it like a seesaw. When one side goes up, the other side tends to go down. For decades, the US dollar has been the world's primary reserve currency. This means most international trade, from oil to coffee beans, is priced and settled in US dollars. This gives the dollar a special status. Gold and silver, on the other hand, are seen as a store of value, a safe haven. They've been used as money for thousands of years and are considered real, tangible assets, unlike paper currency which can be printed by governments. So, why the inverse relationship? It comes down to a few key factors. First, global pricing. Gold and silver are priced in US dollars on the international market. So, if the value of the US dollar increases, it takes fewer dollars to buy 1 ounce of gold or silver. This makes the metals more expensive for investors holding other currencies, which can decrease demand and push the price down. Conversely, if the dollar weakens, it takes more dollars to buy an ounce of gold or silver, effectively lowering their price for foreign buyers, which can increase demand and drive the price up. It's a simple matter of purchasing power. Let's imagine you're an investor in Europe and you want to buy gold. You have to convert your euros into US dollars first. If the dollar is strong against the euro, your euros will buy you fewer dollars, which in turn buys you less gold. It's an extra hurdle. But if the dollar is weak, your euros suddenly have more buying power, making gold a more attractive purchase. This dynamic plays out on a massive scale across the globe every single day. The second major factor is investor sentiment and the concept of a safe haven. When the global economy is doing well and there's a lot of confidence in the US economy, investors tend to favor the US dollar. They'll invest in US stocks, bonds, and hold cash in dollars because they expect good returns. During these risk-on periods, demand for safe haven assets like gold and silver often wanes. Why hold a non-yielding asset like gold when you can get returns from a growing stock market? However, when things get shaky, think economic uncertainty, geopolitical tensions, or high inflation, investors get nervous. They start looking for a safe place to park their money to preserve its value. This is when they flock to gold and silver. During these risk-off periods, the US dollar might also be seen as a safe haven. But often, the fear is about the devaluation of fiat currencies in general. Inflation, for instance, erodes the purchasing power of cash. If a central bank is printing a lot of money, the value of each dollar decreases. Gold and silver, being finite resources, can't just be printed into existence. They hold their value against this currency debasement, making them incredibly attractive during inflationary times. So, we have the mechanical pricing effect and the psychological safe haven effect working together. A strong dollar makes gold more expensive for foreign buyers and often signals economic stability, reducing the need for a safe haven. A weak dollar makes gold cheaper for foreign buyers and often accompanies economic uncertainty or inflation, increasing the appeal of a safe haven. That's the inverse relationship in a nutshell. Now for the most important part. How can you, as a trader, use this knowledge? This is where it gets really interesting. By monitoring the US dollar, you can get a powerful leading indicator for potential moves in gold and silver. One of the most common tools traders use for this is the US dollar index, or DX. The DXY measures the value of the US dollar against a basket of 6 major foreign currencies, including the euro, Japanese yen, British pound, and others. It's a fantastic snapshot of the dollar's overall strength or weakness on the global stage. When you see the DXY starting a strong upward trend, it could be a signal that downward pressure is building on gold and silver prices. This might be a cue to consider a short position or to be cautious about taking a long position. On the flip side, if you see the DXY breaking down and trending lower, it could be a bullish signal for precious metals. These might be your alert to look for buying opportunities in gold or silver. Let's walk through a practical example. Imagine you're looking at your charts. You see that gold is approaching a key resistance level, a price point where it has struggled to break through in the past. At the same time, you pull up the DXY chart and notice that it is bouncing off a major support level and starting to move higher. This is what we call confluence. You have two different signals pointing in the same direction, suggests. The resistance on the gold chart suggests a potential reversal, and the strengthening dollar supports that bearish thesis. This combination gives you a much higher probability setup for a short trade on gold than if you were just looking at the gold chart alone. Conversely, let's say silver has been in a downtrend but is now showing signs of bottoming out near a strong support level. You check the DXY and see it's hitting a major resistance level and starting to turn lower. This confluence suggests that the downward pressure on silver might be easing and a reversal could be imminent. The weakening dollar could provide the tailwind silver needs to bounce higher. This gives you more confidence in taking a long position. It's about adding another layer to your analysis. Instead of just looking at one market in isolation, you're looking at the intermarket relationships. This gives you a more complete picture of the forces at play. You can use technical analysis on the DXY chart just like you would on any other asset. Look for trend lines, support and resistance levels, chart patterns, and moving average crossovers. Bearish divergence on the DXY chart could be a bullish leading indicator for gold. A head and shoulders top pattern on the DXY could signal a major trend change and a potential long-term bull market for precious metals. But remember, correlations are not commandments. While the inverse relationship between the dollar and precious metals is strong and has held up for a long time, it's not perfect. There are periods where they can move in the same direction or decorrelate. This usually happens during times of extreme market stress or a global crisis. 2. In a major flight to safety event, investors might rush into both the US dollar and gold simultaneously, seeking refuge in what they perceive as the safest assets available. So, while the DXY is a powerful tool, it should never be your only tool. It should be used in conjunction with your primary trading strategy, whether that's based on technical analysis, fundamental analysis, or a combination of both. Think of it as a weather forecast for the precious metals market. A rising DXY is like a forecast for headwinds, making it harder for gold and silver to climb. A falling DXY is like a forecast for tailwinds, giving them a helpful push. It doesn't guarantee the outcome, but it certainly helps you prepare and position yourself accordingly. To integrate this into your daily routine, I suggest having a chart of the DXY open, right alongside your gold and silver charts. Before you place any trade on metals, take a quick glance at what the dollar is doing. Is it supporting your trade idea or contradicting it? This simple check can save you from taking low probability trades and help you identify high probability ones. It's a habit that many professional traders swear by, and it can significantly elevate your trading game. So to recap, the US dollar and precious metals like gold and silver generally have an inverse relationship. A stronger dollar tends to mean lower metal prices, and a weaker dollar tends to mean higher metal prices. You can track the dollar strength using the DXY index. By analyzing the DXY alongside your gold and silver charts, you can find confluence, gain a leading edge, and make more informed trading decisions. But 2. Always remember that no correlation is perfect, and it should be one tool in your comprehensive trading toolbox. I hope this breakdown has been helpful and gives you a new perspective to bring to your trading. Understanding these intermarket dynamics is what separates the pros from the amateurs. Start watching the DXY today and see how it impacts the precious metals market for yourself. You might be surprised at what you discover. Thanks so much for watching. Views who found this video valuable. Please hit that like button and don't forget to subscribe and turn on notifications so you don't miss our next video. Drop a comment below and let me know if you already use the DXY in your trading. I'd love to hear about your experiences. Until next time, trade safe and trade smart.